Should you put all your money into the stock in one go, or should you slowly invest it over time? It's a common question that freaks out a lot of investors. What if you invest everything and the market takes a nosedive? In this video, I'll simplify a recent study by Vanguard that looks at two ways to invest: lump sum or dollar cost averaging. Now, if you're new to investing, lump sum means throwing all your money into the investment right from the start. On the other hand, dollar cost averaging means dividing your investments into equal parts and investing regularly over time. But here's the thing, investing isn't just about numbers. Human emotions play a big role too. That's why I'll also talk about the good and the bad side of each strategy from a human behavioral standpoint. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Let's start by digging into the research findings from Vanguard, comparing lump sum investing to dollar cost averaging from 1976 to 2022. If you're keen on reading the full research paper, I'll drop the link in the description below. Now, the gist of the research finding is that about 2/3 of the time, going all in with lump sum investment beats dollar cost averaging. In simple terms, if you invest all your money today, chances are 2 out of 3 times your returns after 1 year will be higher than if you spread your investments over 3, 4, 5 or 6 months. This study covered all kinds of markets, both developed and emerging, and the results matched up with what we see in the US market. Now let's tackle the next question. How big of a difference are we talking about in terms of performance? According to the study, if you go all in with 100% stock portfolio, half the time lump sum investing can give you 2.2% higher returns compared to dollar cost averaging over the course of 1 year. So there's a 50-50 chance that going lump sum with your investment in stocks will leave you with 2.2% or more in returns. Now, if you opt for 60% stocks and 40% bond mix, there is a 50% chance that lump sum investing could get you 1.8% higher returns by the end of the year. And for a 40% bond and 60% stocks combo, there is a 50% chance that lump sum investing might get you 1.2% higher returns. Another study from Morgan Stanley found that lump sum investing came out on the top 55% of the time, outperforming dollar cost averaging by 0.41% over the course of 12 months. While the empirical evidence shows that lump sum tends to outshine dollar cost averaging, there is a glaring risk with lump sum investing. Imagine you put all your money just before the 2020 COVID-19 crash, or the 2008 financial crisis, or the dot-com bubble burst of the year 2000. Your investment's value would have plummeted significantly and it would have taken quite a while to bounce back. Sure, in the long run of 5 or 10 years, you might recover all your losses and even make good returns, but the psychological impact would be real. Especially for people who can't handle the ups and downs, they might be tempted to pull their money out instead of waiting for the market to bounce back, resulting in a permanent loss. So, those who prefer playing it safe and don't cope well with the market swings, going all in at once might actually be a counterintuitive move for behavioral reasons. Now, you might hear people saying they can predict where the stock market will be in the next year. But here's the truth. Predicting short-term stock market moves is nearly impossible. That's why dollar cost averaging is like a safety net. It stops investors from going all in when the stock market is sky high and gives them a chance to buy in if there is a dip during the investment period. By dollar cost averaging, you spread out your purchase over 3, 6 or 12 months, averaging buy-in price. This helps to lower the risk of investing right when the market is at its highest point. It is especially handy for those who are a bit cautious with risk, offering them a structured plan and better emotional control over their investment choices. If the market takes a nosedive during your investment period, you get the advantage of buying stocks at the lowest prices. However, there is a downside to dollar cost averaging, especially when the market is on an upswing. In a rising stock market, each time you buy, the price is higher than before. Plus, since you are spreading your cash over time, you miss out on some gains as the stock market goes up. The research shows that when dollar cost averaging, you miss out on gains about 2 out of 3 times. But here's the twist. If it helps you stay calm and sleep better at night, sacrificing a bit of gain might just be the right call for you. One way to reduce this downside is to shorten the investing time frame. Instead of stretching your investment over a whole year, you could divide it across 3 or 6 months. This way, you cut down the risk but still get a piece of the gains in the rising market. Now let me share my personal approach. Even though I understand that based on evidence, going all in at once might give higher returns, I like to spread my investments over 3 or 6 months. It's just my personal preference. I would rather sacrifice a bit of gain to avoid losing sleep over a potential market crash. Plus, it helps me stay on track and make decisions without being swayed by emotions.